Scoot over to the edge here.
Hello? Here we are. Say hello, Ryan.
Hello, everybody.
Hey, Mom Nation. My iPad is like a little bit wonky, so I'm a little confused here and trying to fit Ryan into the screen.
A little closer
yeah, we
here.
have to get really close. That's okay.
Right,
I like him and he smells good, so that's good. All right, so we've got 10 questions that I have gathered from the group. Hi, JD. And feel free to comment below too. So if you've got any questions, that pop up instantly while we're talking, feel free to comment below and we will get to as many as possible. All right?
Awesome.
Are you ready? JD, am I angled appropriately? Let me know if not. Let me know if I need to switch the iPad because it looks a little weird on my end. Anyway, here we go. Without further ado. Finance Ninja Ryan.
Yes.
First question. How does one apply for a mortgage?
We try to make it as simple as possible to apply for a mortgage. I mean, the first step in the process is we need to take a mortgage application. And to do that, really, you just need to collect your general information. First name. Oh, that's even better. That works.
That works.
So,
thanks, JD.
First and last name, date of birth, social security number. We need address, and we need information about your work, your employment, and assets. And once we collect all that information, we do a credit check, and we can determine, once we have all that information, how much we could approve you for from there. So taking that application, you could do it, one of three ways. You could do it over the phone, which pretty much 90% of the time, that's what we do. We just do it over the phone. Only takes 10 minutes. We try to make it as quick and easy as possible. Or you could do it online. We have some clients that want to do it kind of later in the evening when we're not available. And if you want to do it that way, you could actually fill out the application online. Or, of course, you could come to our office where we're here. This is my office right here. We're on Baseline in Val Vista in Gilbert. And a lot of my clients like to be face-to-face. Some don't like giving the information over the phone. So if you want to do that, you can schedule an appointment with me and come in and we could take the application that way. So that's really the first step in the process of getting pre-approved, is taking that application, and we could use one of those three methods, whatever works best for you.
Awesome. So website, probably pretty convenient, but
yes.
Nice to have you on the phone and nice to have you in
right.
person in the event some questions pop up and stuff like that.
Yes, that's how we really recommend doing it in person or over the phone, because the application, it just asks basic questions, but there's a lot more to it. There's always a lot more explaining with a lot of things, with job history, income. It's not always cut and dry, so that's why we like to discuss things in person or on the phone. So that's what we typically recommend.
Awesome. And if you come see him at lunch, you might be able to go to Nando's.
Yeah, we're right here. I can look at it all day long.
I can smell the chips cooking.
Right.
Next question, Finance Ninja. What is a pre-approval and why is that important to me?
So a pre-approval, like we were saying with the application, once we take the application and do a credit check, and based off of your income and assets, we determine how much we could approve you for. So there's two types of pre-approvals, really. There's a credit approval, and then there is a full pre-approval. So a credit approval is when we just take the application and do a credit check. I could really determine a good ballpark of what we could approve you for. But the only issue with that is when you get a pre-approval letter, it's only going to show that us as a lender reviewed your credit and your application. And that's it. And Katie, you can probably attest to that. That doesn't really mean much if you're wanting to make an offer on a home.
Right.
So really what you're going to want to do is have a full pre-approval. And that's when we take the application, pull credit, and we actually collect all of your income and asset documents. So typical things that we need is 30 days of pay stubs, 2 months of bank statements. We need 2 years of W-2s and tax returns. And once we have that, we review everything. It only takes about 24 hours, and we could issue a full pre-approval letter, which basically means that you could go out and make an offer on a home. So that's what's important. You want to do that up front before going out, because if you find that dream home with a hot market like this,
Correct.
You need to make an offer right away, and you need to have that pre-approval letter in hand. So that's why it's always smart to do the application and the full pre-approval before going out with Katie and her team.
Absolutely.
Because, you got to make those offers quick nowadays.
And we don't want heartbroken mamas that find the house they love and then, oops, got to get pre-approved, and oops, while I'm doing that, somebody else bought the house.
Yep.
Not good.
Right.
Next question, Finance Ninja.
Yes.
How is my payment calculated?
So your payment is calculated. There's 5 things to look at when you're trying to figure out your payment. So there's a short acronym for it. It's called PITI. So it stands for principal, interest, taxes, insurance, and then there's also HOA. You got to factor that in as well. Not all homes have it, not all communities have it, but that's also a part of the full payment when you want to consider the total mortgage payment and what your total out-of-pocket each month is going to be. So one thing you got to be wary of is when you go online, when you're on Zillow, for instance, or Trulia, sometimes those mortgage calculators, they only show you a small piece of that puzzle. They only show you the principal and interest.
Good point.
So they leave out taxes and insurance and HOA, and that's a big part of your payment as well. So we run into that a lot where we have clients call us and they're kind of confused about what their payment is going to be, and they're assuming it's going to be a lot less because they're only looking at principal and interest. So what we recommend is to get the full payment. You could actually, we have a great app that has a good mortgage calculator. Our website has one too. It's thegilliamteam.com. We could probably post that later.
Yes.
Or you could just call me. I run a lot of payments for my clients when they find a house that they really like and they want to know the actual payment factoring in taxes, which I could look up for you, HOA, which we could get from the listing, and also we could get the mortgage insurance calculations because you want to get an idea of everything to know your total monthly out of pocket. So again, it's principal, interest, taxes, insurance, and HOA. That's everything that's included in the payment.
Super important. Thank you. That was very thorough.
Yes.
Once we're under contract and we close and we've got our mortgage and we're making payments, is it possible for a payment to change?
It is, yes. And there's one thing that won't change. If you're doing a fixed mortgage, which 95% of what we do here are 30 or 15 or even 20-year fixed mortgages. So if you have a fixed mortgage, your principal and interest payment will never change. That's going to stay the same unless you refinance. So that number will not change. But one thing that could change is your taxes and your homeowner's insurance. So taxes go up each year when your property values go up. So it's kind of a it's nice because it means that your home value is going up, but at the same time, taxes get reassessed and those could go up. So when your taxes are increasing, your total payment, like I said, the PITI, since taxes are a part of that, your payment could increase a little bit with the tax increases.
Good answer. All right, next question. And if anybody has any questions that are popping up that I have not asked Ryan yet, just go ahead and comment them and we'll get to as many as we can. You touched on this just a tiny bit with the first question, but how long will approval take? And maybe, how about this? How long will approval take if there's a little hiccup in my credit or a little something that I need to take care of?
Right. Well, if you are qualified, like I was kind of saying with the first question, taking an application, we could do it over the phone, and just a regular credit approval only takes about 30 minutes. We try to make things pretty quick and efficient, and I could tell right away if we could get you qualified or not. So we try to make that pretty quick and easy. But if there's some issues, if the credit isn't there, or if there's some income things we have to address, we put you on what's called the Path to Buy program, and we put the steps together that's required to eventually get you approved. So sometimes you just have to pay down a credit card, or maybe pay off an old collection that keeps popping up. So we try to put you on a plan to eventually qualify if on the phone when we're taking your application you're not quite there yet. So to answer the question, with just a regular credit approval, we could get that done in half an hour. To get a full pre-approval, reviewing all your income documents, we usually do that same day, sometimes 24 hours, depending on how much documentation there is. And if there's like a path to buy type scenario where we have to do some work, that could change from, depending on the certain situation or scenario that we're working with.
Awesome. Kind of a two-part question next. Yes. What is a mortgage escrow account? And then Cindy is asking if we can get a mortgage without escrow.
Yes, that's great. So the escrow account, really what that is the mortgage company is collecting some of your taxes and your insurance each month, and they're putting it into an account. So whatever your taxes are and your insurance are, they take a 1/12 of that basically and collect that and put it into an escrow account. So when it comes due, because taxes are due March and then October, and your yearly homeowner's insurance is usually due on the anniversary of your closing date. So when those come due, you don't really have to worry about it. It gets paid out of that escrow account because they're collecting each month into that account. and you're paying your taxes and your insurance basically through your monthly mortgage payment. But we've definitely seen a trend where a lot of clients don't want to do that escrow account. So the only thing that means is that if you don't want to do that escrow account, you could pay your taxes and your insurance on your own. So in March and October when they come due, or the anniversary of your policy, you just pay it on your own. So there's a lot of clients that want to hang on to their money and prefer doing it that way. So you do have the option, if you're doing a conventional loan, to take those off and pay those on your own. But if you're doing an FHA loan, you do have to escrow and you do have to pay into an account.
Right, good point. Yeah. What is a rate lock?
A rate lock is, when you have a contract, to lock in an interest rate, you actually have to have a purchase contract accepted on a house, because rate locks are really tied to a property address. Mm-hmm. So what that means is when you find your dream house and you want to lock in your rate, what we're able to do is for anywhere from 30 to 90 days, we could lock in your interest rates. Rates are increasing. They have been, for the past 8 months. We've seen a pretty decent increase since January so far this year.
Yes.
So what that means is when you have a contract and you have a house, we'll lock you in. So even if rates continue to increase, your rate is going to be locked in and you won't have that increase actually. So it's a good protection against what's happening right now with rate increases. But one of the benefits too working with us though is we have about 12 different banks that we work with. Chase, U.S. Bank, Wells Fargo. So if we lock you in and we protect you against increases on an interest rate, but if things go a little differently and rates actually drop, we could switch banks and get you at a better deal. So,
right on.
Yeah, you have that protection against rate increases, but we also have the flexibility of switching banks if rates go down. So, yeah.
Awesome. That's good to know. How long is a full pre-approval good for? Christina would like to know.
They're good for 90 days, actually. That's how long your credit report that we pull is good for. And if we need to extend, if you haven't found a house or if you're wanting to keep looking, the only thing that we need to do is just do another credit check and maybe get some updated documents, maybe updated pay stubs, maybe an updated bank statement, and then we could extend it another 90 days, actually. So it's pretty easy to extend if you hit that 90-day mark.
Awesome. What is an appraisal?
An appraisal is, when we have a home under contract, what we're required to do, we have to make sure that the home is worth what you're buying it for. So what the appraisal is an appraiser goes out to the home, inspects the home. It doesn't do like a full 4-hour home inspection that Katie's crew will help you with. It's really just a quick review of the house, and they see if there's any repairs that need to be done, and they measure the house. And they also pull home sales within the area to determine how much that home is worth. So really what we want to make sure is that you're buying it for what it's worth. So the appraisal really ensures that. And sometimes if the appraisal comes in low, we might have to go back and renegotiate and make sure that the seller drops the price, because we can't lend on more than what the house is worth. So that's why it's really important to get the appraisal.
Right. And they don't want to take it from me because I'm a party to the contract. So they need somebody that's like third party and not, a party to the immediate contract.
That's correct. Yes.
So otherwise, I just do it all day long. How much will my closing costs be?
Great. Yeah, closing costs could really vary depending on the purchase price of the home. Because our fees are actually they're set; they don't change, and we don't charge extra percentage points. There's a lot of lenders that charge maybe a 1% origination fee. So if you're buying a $300,000 house, that would be a $3,000 origination fee. We don't do that. We just have a set fee for processing, underwriting, lender fee, and doc prep, and it's $13.95 for Waterstone's fees. The rest of the fees that are usually included are taxes, insurance. There's also title fees, appraisal fee, maybe even a home warranty. Mm-hmm. So, what we see is that closing costs could vary anywhere from about $4,000 to maybe about $7,000 if you're buying a more high-end home. So it really depends, actually, on the purchase price, but we could always give you a pretty good quote if you're looking to make an offer on a certain purchase price. If we know the taxes and the insurance and if there's going to be a home warranty, we could give you a pretty good estimate about where it's going to lay between the $4,000 and $7,000.
Awesome. I'll vouch for that. 2 questions regarding down payment assistance for first-time home buyers. Can you get into those details a little bit for us?
Yeah. There's 2 great programs that are available for down payment assistance, and they're called the Home in 5 and Home Plus. And both those programs are pretty similar. It just depends on what kind of financing you're looking for or what areas you're looking to buy. But the bottom line is for both those programs, you get anywhere between 2.5% and 6.5% to help with your down payment.
Dang.
And the cool thing is that you typically only need 3 to 3.5% down to buy a house. So those grant programs could pay for your entire payment or down payment and some of your closing costs as well, depending on the program you're looking at. So they are available. There's some restrictions. You need to have at least a 640 credit score. You have to make less than about $92,000 in total household income. And there's some other guidelines, basically, like they're a little bit more strict regarding how much you could qualify for. If you're bringing your own down payment, you could usually qualify for more than if you're doing the grant program. So we do a lot of those. I'd say maybe a third of the loans we're doing right now is for first-time home buyers with those grant programs.
Wow.
The only drawback with that program right now is that the interest rates are set by Maricopa County, and they're usually about 1% higher than the actual percentage rates is if you put your own money down. So you are technically paying for that grant in the long run. And also, if you sell or refinance your home within the 3 years of purchasing it, whatever of that grant program that you haven't used, you'd actually have to pay some of that back. So that's another kind of a drawback of the program. So if you have the down payment, I don't always recommend it because of the higher interest rate, but if you're a first-time home buyer and you want to get into a home with no money down, they're great programs to have. Especially
if you feel like that's going to be a home for you for at least the next 3 years.
That's correct. Absolutely.
Which, gosh, who wants to move under that? Just ask me. I'm doing it again. Next question. What do I need to bring to closing?
So to closing, typically what you need to bring in is your identification, of course. You need to bring in your license, or you could bring passport, for instance. And then you have to bring also the money for the down payment or the closing costs. So you could usually do that by wire, or you could do it by cashier's check. And in closing, you go to the title company and you sign all the final documents. And of course, after you give the closing funds, that afternoon, they record with the county as you being the owners of the home, and you get your keys. So there's not much you need to bring in. That's
your
the
keys
fun
and
part.
Your present.
That's the seller. Yep, absolutely. Yep, and your closing present.
Exactly.
So that's the fun part. Yeah, the signing usually takes maybe 30 to 45 minutes. And if you have the closing funds, you have your ID, in the afternoon you'll get your keys.
Awesome. All right. Well, thank you so much, Finance Ninja. Are there any other questions before we go? Anybody? No? You're all educated? Cool. Well, thank you again, Ryan.
You're welcome.
It's always a pleasure meeting up with him, isn't it? He's just so phenomenal and so much information. We will do this again. If you're watching this on the replay, please comment replay below with your question, and I will get that answered for you. Alrighty? You guys have we got one question. Wait, we can't go anywhere. Good ways to boost your credit score.
Great. Okay, to boost your credit score, there's a number of things you could do. One is paying down credit cards. A lot of people think that it's just, late payments that lead to lower credit scores. That's not always the case, actually. If you have a credit card with a high credit limit and the balance is approaching that high credit limit, your score drops. So typically, you want your balance to be about 30% or less of what your high credit limit is. So that's important. Another thing that you want to do to increase your score is, and I think we talked about this at another Facebook Live, but if there was any late payments, one thing that you could do is if there were kind of one-off late payments, you've had the card for a while, and maybe there was just 1 month where you missed it, that could have a really big impact on your score. But if you call the creditor and ask for a goodwill removal, they'll sometimes do it. I see half the time that they actually remove it if you've been a long-term customer. And removing late payments is another way to get your score increased. And on top of that, if you have any open collections, charge-offs, anything like that in the past that are still pending, those are weighing your scores down. So if you settle those, if you could actually show that there is zero balance, that's going to give you a good boost as well to your credit. Awesome. The questions are rolling in. You got more in yet? Good. Absolutely. All right. He's good. If you sell before the 3 years, does the repayment of the grant funds just come out of the proceeds? It does, yes. It comes out of the proceeds. So, as property values increase, you basically, you might still have equity in the home. You could use some of that equity to pay that loan back. And again, with the grant program, however much money that you get, the amount that you owe back if you sell within 3 years actually diminishes by 1/36th each month. So basically, if you have, let's just say, 1 year left, and that's going to be your 3-year anniversary, you only have to pay 1 year of that grant back.
Gotcha.
Yeah, so it's not the full amount. The more you live in the house, the less you have to pay back gets. And then once you hit that 3-year mark, it goes to 0 and you don't owe anything back.
Awesome. That's good.
Yeah.
That's good to know. Next question. Does Waterstone keep or sell their loans?
Yes, we keep the majority of our loans. We service most of it with Waterstone Mortgage. But if there's a better pricing out there with Chase, Wells Fargo, US Bank, then we lock in with them. And then after closing, they service the loan. So we always have that discussion because we have some, clients that might not like a certain bank. So we try not to lock it with anybody who you don't want to work with. But if you have a relationship with Chase or Wells or US Bank and you really like working with them, we try to lock it with them, so that's where your servicing will end up. So we only typically, transfer the servicing if we find a better rate with one of those banks.
Cool. Next question. They're just rolling in now. Thanks, ladies. Is it harder to get approved for a loan after having a BK, a bankruptcy?
You just have to wait. There's a minimum waiting period after a bankruptcy before you could get a home loan. And it's not as long as you think. It's only 2 years. So after the date of the discharge, you wait 2 years and you could actually get a home after that. So if we have any clients that have to go through a bankruptcy, we typically say after it's discharged, it's important to reestablish credit. Maybe get a secured credit card. And what that is, you go to your bank, and secured means you just put maybe $200 down and they give you a credit card with a $200 credit limit. And, just maybe charge gas or groceries on it and then pay it off each month and reestablish your credit after a bankruptcy. And after that 2-year wait period, you should have a really good score.
Awesome. All right. I don't see any other questions coming. Going once, going twice. Again, comment replay if you're catching us on the replay. If you've got questions, put that in your comment as well, and we will get the answers to you. Okay, guys? I hope you are all having an awesome Wednesday. Oh, here we go. Cindy again. I'm just going to keep saying goodbye to you, and we're just going to keep going. It's cool. Will a tax lien, what's the rest of it, Cindy? Will a tax lien affect anything?
Yes. Tax liens, typically we are going to have to see those paid off and closed. But if not, if there actually is a tax lien out there and it's not paid off just yet, typically if we could show that you have a payment plan with the IRS to actually eventually pay it off, as long as we have that payment plan in place and proof that you've made at least 3 months of payments towards that tax lien, then we could still proceed with getting you qualified for a home loan. We just have to hit you with that monthly payment against your liabilities, but it is possible if you have a payment plan and if it's not completely paid off, yes.
Gotcha. Good. All right, we've got another one here. If a couple is married and one has owned previously but the other has not, can you still get approved for a first-time buyer loan?
You can, yes. And the grant programs that we were discussing, it's not just for first-time home buyers. As long as it's going to be a primary residence, you could qualify for the grant program. So the answer is yes, you would still be considered a first-time home buyer, but it wouldn't matter anyways because as long as it's your primary, you could take advantage of that grant program.
Awesome.
Yeah.
He's just a wealth of information, you guys. Really, I love sitting with him, and I learn things, and I been doing this for a little while. Okay, anything else? Going once, going twice. Peace out, guys. Oh, does Waterstone offer loan recasting?
Loan recasting, yes, that is something that we offer. I was trying to read the question.
Yeah, right. The questions are coming in.
It really depends on the specific situation. So if that's something you want to ask about, yes, that is something that we do offer. I could help you with that if you want to reach out to me directly.
So Cindy, call Ryan. What's your number, Ryan?
It's 480-635-3035.
And he texts. Because who doesn't text these days? So text him. All right, guys. Really got to go now. Bye. See you soon.